So today I'm going to give my update on the stock market crash in this 2022 stock market crash that we're going through. What is the outlook like and what can we expect going forward? And potentially, could we be seeing towards now the end of this 2022 stock market crash? As you guys know, I've been kind of updating you through this whole situation over the last few months as the stock market has been downtrending really from a year when the small caps, which were the kind of are always the first ones to go, which were about a year ago, a lot of the small caps started falling off a cliff, and then eventually around November time is when we got the whole market starting to follow it. And since then, I've been with you guys through this dip, talking about buying the dip, how long could this go on for, everything would be okay. And today I'm going to have a look and see, is this potentially the 2022 stock market crash starting to come towards an end? And I've got some interesting stuff to show you guys. Now, before I do get onto that, as you probably can tell, we're in a little bit of a new setup here. This is going to currently turn into the new office, so I will be filming my videos in here going forward. There's still a lot of work to be done. We're going to be painting these walls, we're going to be putting a bit of a backdrop on. The camera and the whiteboard will be going on there in a few weeks' time. There's a lot of work to be done, but bear with me for the next few weeks. As you probably watch the videos go on through the next couple of weeks, you'll probably see a few things start changing around. So yeah, it won't be brilliant to start with, but that will sort itself out in the next few weeks anyway, just so you guys know, and the whiteboard will be making a return. But yeah, getting onto this kind of stock market crash, and is there potentially an end? Is this potentially coming? Is the crash nearly over? So we're going to take a look. Now, at the moment, as you probably know, stock market's been hit absolutely hard. The NASDAQ is down massive until we had a little bit of a bounce on the last few weeks, and we were down at over 30% on the NASDAQ. Now, interesting enough, that actually was a bigger dip than the CV dip. That's correct. I just said that correct. The NASDAQ dip in this current crash is worse than the CV dip. That puts it into context or perspective how big of a crash this has been. This has been a crash bigger than the CV. You know, when you talk about the CV situation, when we're talking about, we talk about the worldwide economy shutting down, people being locked indoors, companies just shutting the doors completely. That was a big scary time for the stock market and the economy. You go into what's going on right now, and there's a few problems out there, but companies are still operating not too bad. Sure, there's a few having a bigger issues than others, and some companies are cutting the guidance slightly, but it's not a massive recession. And when you look at the indexes at the moment and you look what's going on here, the stock market is always future thinking to the economy. The stock market always crashes before the recession is confirmed. And what you see in the stock market right now is the stock market has crashed. The stock market has priced in a big, massive recession. The stock market has priced in a recession getting towards the lines of an 08 recession. And when you look at the data that's coming out now, you're looking going, okay, there's a bit of an economic slowdown going on, for sure. But there's not a crash. There's not a crash, not a big massive recession like 2008. And that's the big thing that's going on here. What you've seen in the stock markets in the last few months is you've seen a stock market that's priced in a big massive recession. And when you look at what the data is, sure, there's going to be a couple of economic impacts at the moment, but not as big as what the stock market's priced in. So when you look at the correction that we are on, or the crash that we are on, it is far outdone what the effects of the economy will be. And now that the economic data is coming out, and it's like there's not really that much change going out there, what we're going to see sooner rather than later is, and this is why I've always been bullish in the stock market, even in this year, we're going to start seeing the stock prices do very well. And now the NASDAQ has crashed 30%, which is more than the CV dip. What does history tell us? Well, I got this from Dustin at Jazz Wealth, which is a fantastic YouTube channel. Kind of does a bit of a market recap at the end of the day, what's kind of gone on. And when the NASDAQ declines 30% from highs, this is its performance after that 30% decline. So 1 week later, it's 3.6%. 1 month later, it's 7.7%. 3 months later, 17%. I mean, that is a massive bounce in 3 months. 6 months, 21%, and 1 year, 22%. Now, obviously, in the stock market, no one can predict the future. The stock market could go down 10% from here. At the same time, the stock market could go on a massive rally from here. But rather than me guessing, which I would pretty much be doing, let's go off historic data. What does tend to happen from here? Well, as you can see, it normally has a very 1 year big and massive bounce, particularly in the first 6 months. And this is also why you also can't time a stock market crash. History tells you the best thing you can do is just average into positions throughout the crash, because when the stock market does flip, which we don't know when that will be, very quickly within 1 month you can miss a 7.7% return, which is massive. That's a big massive part of the dip that you've already missed, and if you miss it from 3 months, you're missing 17%. That's nearly half the rally, half the recovery from the dip, which is very important. So that's why it's important. You see a lot of people flip-flopping out of the market. You can't do it, because very quickly you will miss this rebound very quickly. And now we've had the worst S&P start since 1939, so that's something to put on your CV on your investing career. When people say you've never been through a proper dip before, if you've not been through the CV dip and this is your first time, you can say I went through the worst S&P starts of the year since 1939, and that's how much fear is priced in now. We know there's no greed. It's massive fear out there. Look at the fear and greed index. It's massively towards the fear, and you're getting stocks like Snapchat being used as an economic indicator. People saw Snapchat the other week and went, oh yeah, Snapchat is now going to be the economic indicator, and Snapchat crashed the whole stock market last week, which is absolutely stupid. And what you're starting to have here now is you're starting to have stocks starting to get priced at quite good valuations. Now, obviously with the Apple, I don't know if I'd still say that's a good valuation, but you can see here that Apple, since that Snapchat numbers has had a bit of a rebound, but especially in the small market caps, they've all been bouncing since like the 12th of May, and they've been putting a good recovery in. So even though these are up 5%, the big caps really haven't started recovering since the last week, since the whole Snapchat situation. Same with Microsoft. You look at Microsoft, there's a bit of a recovery starting to come in here now, but when all the other kind of markets started recovering, it's up 7%. And this is the thing with a lot of small market caps. Something like a DraftKings, for example. A lot of the small caps really have bottomed out around about the 11th of May at the moment. So that means that if you look at the 11th of May, in a course of nearly 2 weeks, something like a DraftKings is up 43%, which is massive. If you look at something like a HIM, same again, like the 11th of May, it's up 31%. And you're seeing some stocks starting to recover slightly, but you're seeing a lot of the small market cap stocks, which are always the first ones to rebound, have bounced a massive way. You look like the looks of DraftKings, for example. It's 43% in 2 weeks is a massive rebound. And this is the thing, is that when you have a lot of stocks beating down these sort of valuations, and then you do have a rebound like the Nasdaq, if the Nasdaq rebounds in 3 months 17%, for example, what's that going to lead DraftKings and HIMs to do? And this is what I've said previously so many times before. People are quite aggressive to like a stock like DraftKings because like, oh yeah, it's down 50% within 6 months. It's a terrible company. But that's because we're in a bear market. The same happens in the bull market. If the Nasdaq, for example, wants to go up 17% in 3 months, you've seen what DraftKings has done in 2 weeks here. It's up 43%. If the Nasdaq was up 17%, DraftKings would be up more than 17%. It would have a massive rebound. And that's also the other thing you got to be careful of, is that, and you can't time the market, and the best thing is to average down, because when that rebound happens, the rebound happens very, very quickly. If any of you guys have been through the CV dip, you would have seen that rebound happening, and that's also something to be careful of. Now, some of the main issues that are out here at the moment is, first of all, inflation. One of the main, I would say the main reason why we're probably having this situation right now, obviously there's some tough comps out there, shipping, which, by the way, shipping is coming down as well, which no one's talking about. One of the main issues, shipping is coming down a bit slightly now, which caused an impact. The Ukraine-Russia situation, of course, which is currently still going on, even though it's not really making the headlines as much nowadays. But realistically, that isn't really having that much of an impact on, the US economy, for example. So you've got shipping issues, which are starting to resolve itself. The Ukraine-Russia situation, which is still currently going on, but obviously hasn't had as big as effects on the economy as I think a few people thought it would have. And when you look at inflation, which I would say is probably the main cause of this crash that we've been on, inflation's actually coming down this month, which you probably won't have seen it talked about as much, but it has come down. So it's broken this uptrend. As you can see here, it's actually 8.3, and it's actually only up 3.3%. Now, obviously, beforehand, we were talking like up 7%, I believe it was. So yeah, this is over half. So you've actually had inflation break the curve, and now that it's going off, comps that are higher up, it's getting very close. So, obviously when we talk about inflation in the next couple of months, if this kind of comes down this this downtrend, obviously if inflation comes down, what's that going to lead to? Interest rates, or interest rates going to start slowing as well. And then you have the major concern that's been overhanging, I would say, that's caused a lot of this crash, has been kind of broken really. And one of the key things on the economy is employment. As long as employment is very good, people have money. People go spend money, and obviously businesses will do well. So a lot of the macro events at the moment are affecting the companies slightly at the moment, but as long as the income's still coming in, revenue is still coming in, these companies will still do okay. And the big thing is employment. As long as employment's still very strong, which it is doing at the moment, then the economy should be okay. And at the moment, all of the employment data is still very good at the moment. So that's probably the key things to be watching. So at the moment, it's looking pretty positive. Obviously, you can't predict the future in the stock market, but when we talk about is potentially the 2022 stock market crash is over, I mean, for me, I've always said for a long time, like this dip that we've been on has been way overdone. Like, we priced in a massive recession here, and at the moment, until I see the data of that we are moving in the recession, what has affected companies at the moment should affect the stock market. But we talk about the stock market should have been affected maybe 10%, maybe 15%. And we talk about, the Nasdaq down 30%. It's unbelievable. So when you're having, this much negativity priced into the stock market, and stocks really pricing that in, especially the small caps and the medium caps, which are priced at 2008 levels now on a P ratio basis, it's massively overdone. So from my point of view, when you look at the valuations and you justify how bad it is out there, I think that we are, without doubt, moving towards more of the back end of this situation. Whether or not that's true, we'll have to wait and see. But at the moment, there has been a bit of a strong rebound in the stock market. It is Memorial Day, but the pre-markets are looking pretty strong. So, I mean, if we lead to another bounce, that will be interesting to watch when the stock market does open tomorrow. But yeah, it's positive news out there. And like I said, when you look at historic data, same again, that does back up that, it can't stay down here, these sort of valuations forever. So yeah, I'm currently still buying the dip, dollar cost averaging into these situations, and I believe in the long term, when we do have this rebound, I will get the benefits for that. So yeah, I hope you enjoyed the video. Anyway guys, if you could hit that like button, you hit it last time when I asked you to, and it really did help the views again, so thank you so much, and I'll catch you in a bit.